First of all, I want to thank you all for attending. We generally have a small group who do this live, but last year we had close to 1,400 people catching this later. Those of you that caught it, I hope you enjoyed and benefited from it, even more important. While we're looking at the screen, we noticed this was the theme in 2018. Effectively, markets were quite elevated. Very few people felt that the markets were, I can't say properly priced, because some people believe the market's always properly priced, but let's just say they certainly weren't cheap, and people like myself felt that they were expensive, despite the fact that they were going to go higher, which is exactly what they did. So that was a little bit the theme. Don't think about it. Just move ahead, more or less. This, however, is the theme for 2019. In fact, some of which you've felt in the last week or two. Those of you who track my work knew not only was September and October an issue in the markets, but we had to worry about the Fed, the last week of the Fed. And we'll go into that in some detail. So effectively, this is the issue. And there are a number of issues out there. Many, many years ago, we said that we didn't really have to worry till 2019 or 2021 for a potential recession. I'm not sure I'm on a recession camp, but let's just say a slowdown camp. There are clearly many, many risks out there, some of which are known and some of which are going to be surprises. So the issue is clearly caution versus making hay when the sun shines. We tend to do these, this is a repeat somewhat of a talk that I gave December 5th. We've moderated it just a little bit. At the end of the year, we like to review what's happened and what's going forward. We present a number of companies that we think are good. We have some talks, we have food, and networking. Unfortunately, this is virtual, so we can't do all of that, but you can do networking. And one of the reasons we like Shindig, and I'm very thankful to have found it, is it's not a dull webcast. You can participate with each other, talk to each other, and it won't disturb the speaker, which is me. So feel free to network with people if you like. Okay, we're going to take a little quiz. I don't know if we can do this, Mike. Can we have everyone raise their hands on certain questions? I think we did this last year, if I'm not mistaken. So well, the question is, there are 4 questions, which is what the audience feels. And during the year, we put this up, and the feeling is very different. So let me just see 1 second if we can do the vote. The first is in the Dow. How many people think that we've seen the high? Now we're talking about 2019 now, and then of course I'll give my opinions. How many people think that that 26,951, which was the Dow high, or less, is what we're going to see next year? So if people, can they raise their hands for this? Let me just see. How do they do this? Oh, yeah, it's good. Okay, I can see this. Okay, so far 3 people think that. How many people, and then they have to undo this, how many people think that we can see 28,000? Those we're going to break the highs, all right? And, clearly an equal number. And then finally, how many people think we're going to the targets that a lot of technicians have over the next year or two of 30,000? Okay, there were a few more earlier in the year when the market was higher. Okay, oil. Totally different feelings now than we saw at the beginning of the year. How many people think that oil is going to be under 65? And I think we're getting the same people voting the same way here. Okay, we have a certain number for that. Think we'll go between 65, 70-ish? A little bit, oh, an equal number again. And 80 or more, which was a very prevalent. A lot of people are bullish on oil. Well, certainly we're too cheap, and I agree with that. Gold, which being a Leo I love, 1,300 or less. Okay. Higher than 1,300, between 1,300 and 1,400, an equal number there. And how many gold bulls we have? 1,400 or over. There we have, again, fair number. It's almost equal here. At our events, which very often we have gold companies present so that people attend, obviously a lot of people think we'd go higher. And finally, Bitcoin, which we discussed a lot last year, and we'll discuss only a little bit this year, 5,000 or less. And as we're talking, it's 39.43. Okay, not too many for that. We'll get to 5,000 to 8,000. Okay, and we're going to take out the highs. of 19.5, which, by the way, we were suggesting shorting at about 19.1. Okay, we still have some Bitcoin bulls. We think we're going to disappoint you there. Okay, well, we're going to give you our views very shortly. Those numbers change a bit. I think the interesting thing here of this is the fact that we have a lot of oil bulls here. So that was interesting to me. Okay, what's the big picture? Because before you get into any details, it's always a good idea let's get an overview of what's happening. Can they see this? Can I enlarge the big picture thing for this, Mike? So that we see a little bit less me and more the slide. Let me just see how we do that. Emphasis full screen. How do I do? Is that the center one? No. Hold on 1 second. It's done? Oh, I did it. Okay, so everyone can see the full slide then. Great. Okay, the most important fact, and this is you don't need astrology for, is bonds. And it's not so much bond prices, it's bond velocity. It's how fast is the Fed going to do what they think they're going to do, what they say they're going to do. And as one of the people who felt that the Fed did not have to be the Grinch that tried to destroy Christmas, they won't destroy it, but it was certainly a very stupid communication exercise. But we'll talk about that also. But bond prices, no question. The second thing is trade wars. For us, that's less of a risk than most people think. We consider that low to medium. But China is a very big issue here. Not even so much from the trade wars, but there are issues with China that we'll discuss in some detail. And emerging markets, if they keep raising interest rates beyond what they're saying, or as much as they say, then emerging markets are going to be hit very hard, which then has lots of repercussions. But again, bonds in China is really what you want to concentrate on. So what we suggested for the second time was to lock in or take profits by or before December, January, which is now, ahead of the December, January FOMC meeting. Well, you can see why, in retrospect, that was a good idea. We also suggested, for those of you that can, to trade somewhat actively, and if not actively, at least have some hedges in there. And this is going to be true for the first half of the year, okay? So we're going to be recommending some caution, and now it's pretty obvious. When we said this in December 5th, first, it wasn't as obvious as it is now. We bifurcate 2019. In the first half of the year, his horoscope is going to be a little bit more challenged, and we think that that is very important for the U.S. markets especially, whereas it's very stronger and much more positive in the second half of the year. So what we're saying as a rule, and again, we'll go into months in a moment, in general, be defensive for the first half of the year and be more aggressive in the second half of the year. Digest that for a second, because the same strategy doesn't work as well. One has to be adaptive. If you use the exact same strategy all year, there can be issues. My favorite sayings are, when the markets are expensive, make hay when the sun shines. You may recall from last year, excuse me one moment, I'm getting over a cold here, that when we got up to the NASDAQ close to 8,000 and the Dow at 2,600, that we suggested selling and protecting. And then when it got under 24,000, we suggested buying again as some of the dips, which we obviously had to trade around in the last couple of weeks. But in general, we suggested we hit the top numbers, lock it in, take it out, do whatever you're doing. This is going to be true again December, January, which is here, and even more so in Q2, in the second quarter. You know, where the markets were, to some extent, we think they're a little cheap now, so we're not being as defensive as we were in December 5th, but by and large, this is a general theme. So in 2018, we were interested in North Korea, the recognition of 2% plus inflation, which all of a sudden became noticed, Bitcoin, less of a problem, the trade wars and November elections, all of that were important. This year, primarily, it's U.S. bond velocity, China, and so if you see on the bottom there, we had a yellow alert for December and January, obviously, but in May that I want you to think about and be very well prepared for. It's going to make a big difference. Okay, in general, we like to have 5 strategies, 5 ideas to work with. I mean, as traders, we trade every day and sometimes short term, sometimes longer term. But for a general view, we like to give you 5 ideas. Now, the first one is a repeat of last year, which is to be long copper. Copper worked in the beginning of the year, went up to 310 and stuff, and then came all the way back. So depending on how you trade it, you either made no money or you made a little bit of money. But it's a long-term hold. The second half of the year, especially, we still have targets 350 and above. That's 20%, quite a lot. We like copper companies, and what's holding it back, in my opinion, are the trade war issues. Once those are out of the way, then we will see some action. And even potentially in the U.S., there's discussion that in terms of healthcare and in terms, oh, thank you for some water, how nice. But that in terms of healthcare, sorry, someone just came in the room, so give me a moment. Let me get that repeat again. The fact that both the Democrats and the Republican want to build infrastructure, China is going to play with. Once the trade war concerns are out, we'll see, I think, a big move towards that. Obviously, there's some very fundamental issues too, some serious issues. So over time, and especially in the second half of the year, we expect to see a major copper move. We're playing it again and just holding it. Okay, the second is selective shorts. Obviously, again, this was first said in December 5th, so we're doing nicely there. Here, as a matter of fact, we're going to see that we're actually playing the other side in a moment. But long-short pairs for the most of the year. So one of the safest ways to play the next 6 months is to go long-short. So if you're long stock, you could be short the index, or you can be short, if you're able to pick stocks, then you go and do that. However, in May, we're going to be doubly short. Last year, we did not recommend it. We didn't care if you went short in May and, the sell in May and go away. We said it didn't matter. You could do it. You didn't do it. You're going to be in the same place in September, which you were. This year, it can make a big difference. There's a high risk. Doesn't mean it's absolutely going to happen, but a tremendously high risk for the markets in May, a number of issues. So we definitely recommend there we will be naked short, probably, but definitely have hedges in. We'll be talking about that more as the year goes on, but you have to be concerned for that time. So what for most people can do is something different. And again, this is something now more people are talking about, seeking a safe haven with income and cash. For the first time, people are talking about how cash, with close to 3% yield, maybe give you more than the market will give you. So we have two types of plays, depending on whether you're an aggressive player or a conservative player. If you're aggressive, like myself, we like royalty and streaming companies because they give you cash and growth. We like them, obviously, in the mining, natural resource space, but you can play them, I think, in energy as well. I notice we have a lot of energy bulls here. Excuse me. So you may want to look at some royalty and streaming situations. If you're conservative, then you want to play dividends because traditionally 50% of everything you got in the market came from dividends. So as an example, the ProShares S&P Dividend Aristocrats, and these are S&P companies that have raised their annual dividend for at least 25 consecutive years. Hey, that's a hell of a record. And have a minimum capitalization of $3 billion. Because clearly that's going to be one of the last places people run from. So you may want to look at that and start tracking that. But again, income, cash is more important than it would be at other times. Number 4, who is going to benefit from the U.S.-China trade angst long term? And the answer is the U.S. will. China may disagree, but we think so. But Asia Pacific ex-China, Japan, Southeast Asia, Philippines, Indonesia, and India. So if you're looking to diversify, again, we have to be careful because if the dollar gets too strong, then the emerging markets get hit. However, many people have been moving the supply chain or increasing their supply chain outside of China, primarily because it's too expensive, ironically, that labor, et cetera, is too expensive in China. So people have been doing this into Vietnam and places like that, Bangladesh, et cetera. Again, just something to think about. But a Chinese economy is going to be slowing next year. This is a big, those who know astrology, it's got Saturn all over the place. Now, Saturn's not necessarily a bad thing, but regardless of what happens, March, maybe January, they make nice and markets rally very strong. But in 2019, China is going to be forced to deal with the mismanagement of state-owned assets and debt. So again, you can look at this as a short-term negative, but we're not rushing in there. We would recommend a minimum allocation. That's different. If you're in China, you're not going to sell everything. If you're interested in Asia now, it should be Asia ex China for the year. Fifth, we always look to special situations because regardless of what happens in the market overall, China is a big issue. Really has to be watched. It is in a sense going to affect the commodities quite a bit. I think actually still more positive than negative, but there'll be a lot of news because they do have to deal with the debt problem like everyone else everywhere in the world. We all avoid it. But mismanagement and debt is very strong. Hopefully they'll deal with it in a positive way that's good for the people there and good for the rest of the world. But in any case, if you have China exposure, it should be minimum or fully hedged to the extent that you can. And over time in the future, I'm sure we'll be putting a buy on it as well, but it's not going to be certainly in the first half of the year by any means. So that wealth exchange, that China versus other parts of Asia, no question about that. Okay, back to special situations. Last year and always we like to pick a few stocks that will go up 30, 50% or more. Very often by January, February, we made all our money and we could actually put it all into bonds and forget it. We had two last year. One went up 100%, came down again, went up 100% again. The other one just went up 50% and then went in the toilet. Those are trades. The two favorite sectors, one of which I think many, many analysts have for next year is healthcare. And one of which the reason is clearly if you have a company that offers a better outcome or lower cost, I don't care what the broad market's going to do. It's going to make money and the stock's going to do well. So that's one of the areas. We have four up there. You might want to just write them down. I'll leave it up there for a while. There are four little companies that are presented for us in New York. Avivagen, Canfeet, Novalete, and Celsi. You might want to write them down. The symbols are there. These are, again, very high-risk ones. You might even want to do Johnson & Johnson today. I mean, heck, that's an interesting play after the way it's been hit, but you may want to play something else a little easier like a Pfizer. But basically, healthcare is certainly going to be an area that defensively a lot of people want to use. Defensively, of course, a lot of people are already in utilities and consumer staples, but we like the healthcare sector. These are four very high-risk ones. You may not, if you're not in an aggressive part of your portfolio, don't play those, but play the more general healthcare. And the second is commodities. Almost virtually all analysts think commodities are near their bottom. But you need a 2-year horizon for this. It may not be jumping up. Gold, for example, will do very well in December, which it did. We recommended it in October. It will do extremely well in December of next year, and extremely, extremely well in December 2020. But that's pretty far off. So these are long-term holds for us, but they're safe plays. So commodities we like. So there. So gold, we mentioned. I can never imagine who's selling gold as outside of a computer and a hedge fund. Nobody in their right mind actually sells gold. That is the physical gold. We all play games in the futures market, but that's not selling gold. Clearly, it's something that it's going to be stockpiled up. And anecdotally, there's a gentleman we met, because I'm just about to talk about Bitcoin, and then we'll go into some detail, who bought some Bitcoin at $300, didn't sell it when it got to 19,000, didn't sell it at 10, didn't sell it at 5, didn't sell it at 3, never going to sell it, but this last few days he bought gold, which is interesting because last year he bought more Bitcoin. So I think that's an interesting sign that gold's going to shine a little bit more. And of course, Bitcoin we do not like. We're going to go into that in some detail. Blackcoin is a client of ours, so clearly we'll talk about that a little bit later with a big reservation. Doesn't have to be that. Bitcoin we don't think is going anywhere. Okay, that's the big views. Now we're going to dive into them some deeply, and then we'll take some questions. Okay, I guess Bitcoin's next. One of our big 5 plays last year was selling Bitcoin. 3 points, we recommended it. First, absolutely at the top, around 19,000 to the day. Then we also told you that in June it was going to go down in the beginning of June, and then around the solstice, which it did. Then an issue became that we felt any problems with Bitcoin is going to come from outside of Bitcoin, not so much from the horoscope of Bitcoin, which is sort of neutral. So fundamentally, we're saying it's not very good. And if you look what's there, you may want to read it. We've talked about it being a tulip. We talked about it being environmentally destructive. We talked about it being important in the same way that porn was to the development of the internet. But this is old stuff. So let me actually go beyond that. I think anyone who's caught my stuff last year knows we don't think it's very valuable. The issues that affected taxation and regulatory intervention last year were bad for it. Now it's good because nobody in their right mind would buy something unregulated and insecure. The security breaches, the theft, the viruses, the fraud, the scams are just all over the place, and you haven't seen anything yet. Everybody agrees that 90% of the ICOs are going to zero. Most people, some people like myself say 98. But basically, there are lots of issues. But the number one issue that's most important with this is the competition. Most people who believe in it already own the stuff. The only issue is it a pyramid scheme or will it attract new investors? And until a number of issues such as security are dealt with, it's not going to happen. We're still in the camp of 3,000 before 5,000. Might go to 5,000 first. But we do believe we're going to 1,000, which is clearly a technical target that we were in 2017. If Bitcoin goes up, the altcoins go up much further. And that's something to remember. If you're playing it and if you believe in it, Bitcoin is not the winner. I always like to say in an event, how many people have an AOL address? How many people use Netscape? These are old technologies. And clearly there are newer technologies to go for. So fundamentally, we don't think it has value. What we do think is that we're going between third and fourth generation. If you like Bitcoin, then down the road, something like ADA or Stellar is going to outperform it. Actually, I think they're going to drop about 50% more, and then I think I'd be interested in buying it, not here. And then there are fourth generation coins that we like. There are government cryptos. The point is, Bitcoin, to me, is a very sad situation because many people are just going to lose a majority of their money. And we definitely have, there are two sorts of people, those who say it's going to 20,000 and those who say it's going to $100. I think we're more likely to see $100 than 20,000. But that doesn't mean other altcoins won't work. That doesn't mean blockchain isn't good. That doesn't mean smart contracts are good. But play with the modern winners. If you remember the internet, there were hundreds of players. Only a few made money. You look at marijuana, many of them are making money less so now. Only a few are really going to last there. So we're in a different market. Yes, it may get accepted, but it's much more likely it has no value. And what's most important is what happened in October with the Bitfork, or November with the Bitcoin fork. And all of a sudden people, who owns Bitcoin? There are 1,000 people that own 70% of it. 70% are Chinese. Most are miners. Not miners like in gold, but crypto miners who solve math puzzles. They have big egos, as you can see in the fights. And is that who you want to give your money to? Is that who you trust it to? And believe me, blockchain today is not secure. It can be, but it's not. So be very, very careful with it. There's plenty of money to be made trading, but investing in Bitcoin, But it's not a number one. It's not one of our top 5 like last year. Last year was a no-brainer. And basically, when you go from 19,000 to 3,000, thank you very much. So you lock it in if you wish. Gold. Most of you have seen this before. Bitcoin, marijuana is less of an issue. There are people now starting to look at gold again. We may very well see 1,300 this year. We're certainly going to see it next year. We're going to see 1,350. And I think we're going to get up to 1,370. So we're long-term holders. We're fully committed, so we're not putting more money in. We also like copper and base metals, but we think it's undervalued. We think it's hedge fund games. But we're going to talk about the fact that it's actually going to be going down very shortly, which we don't like. But nonetheless, as a long-term investment, it's fine. Yesterday, it went up 4% when the markets were down. So we still like gold, and we can talk about it. But not all gold stocks are going to go up. You have to be selective. In fact, one of the things you have to be in general is selective. So we see a 1,350 test next year, 1,400 test before 2020. We actually thought we would see it this year. We didn't get it. So not one of our brilliant moves, but we'll be fine in the end. Look at what it says about traders, however. This is the thing you have to watch out if you're a gold person. We said to buy February 2019 gold, and it's doing very, very nicely since October. But You may want to sell June gold. That is for a couple of months. It may be going down, and then buy December gold again. So if you're a trader, you may want to lighten up or protect once we get it past January. What is to say from February, March, April, May. But once we hit past June, we see it going up again. So if you want to protect, you can. If you're a trader, you've got to be very concerned about this. If you're an investor, I wouldn't worry about it if you've got good companies. But the stock may be going down again. I think we'll see 1,300 before 1,200, and then eventually 1,300, excuse me, 1,250 will be the floor, and it'll be a 1,250 to 1,450 range. But it's not a straight line up. It's good now. It's good through January, but then there's some issues. Hate to say it, I won't sell any personally. We may protect a little. Okay, dates. One of the things you want to look at are dates. Well, obviously, first we have the non-astrological dates. We have December 18th and 19th. Well, we just had that, and the Fed, I think, did a terrible job of communicating it. If they did 3 raises next year, if they had left Christmas alone, markets would be 2,000 points higher, everybody would be happy, and the Fed would reach its numbers. There was no compelling reason to do this in December. I think it's a mistake. But like the Fed before, I think the markets will recover in spite of the Fed, not because of the Fed. And that's a very sad thing because they don't have the same power they had up to the 19th. So they'll talk it back and forth. But in general, I think it was a big, big mistake. So December 26th, I think there's going to be some buying. Monday may be down. Today may be down. We actually have to look where the markets are. Excuse me just one second. Markets are down, but we may be buying on Wednesday. Some people are selling, but I think the last 3 days of the year will be buyers. Under 23,000, we think the market's not expensive. It's not cheap, but it's not expensive. FOMC meeting the next time, boy, they can really bring problems into January 29th and 30th. March 1st, which are the China tariffs. We've got a lot of dates in here. March FOMC meeting, I don't think is that important. UK potentially leaving EU. You're going to see a lot of risk. And then, of course, the next this is a red letter one. I think they're going to mess up again May 1st. I don't know why and how they're going to do it, but I think they're going to mess up. So there's a lot of dates that traders have to look at. But if you're hedged, if you go against risk, you don't give a crap. If you actually followed our advice back when the market was 8,000 NASDAQ, you didn't care what happened afterwards. You could trade around it. You made a lot of money. You locked it in. But you've got to be risk adverse or be very active trading for the next 6 months. There's a lot of elements in there that's going to bring the market up and down, and vol is going to be high. Okay, astrologically, January 13th, Jupiter, Neptune, that tends to bring some rallies. A total lunar eclipse, and this one is on the 21st. That takes an effect for the whole month. It's got some Uranus in it, and that means surprises. I can't tell you what the surprises are, or they wouldn't be surprises. But I can tell you volatility, markets going up and down. It could be positive, could be negative. Again, June, we think then the markets will be buying them again. On July 2nd, there's an eclipse. We'll talk about that later. But the most important thing is we're going to be selling in May, maximum short, maximum help by sometime in April. Whether before or after the tax season will depend on what happens beforehand. But we will have our red letter days where we can have a 1,000-point drop. Doesn't say we'll have it, but we can have it. So 200-300-point days mean nothing. We can have a 5 or 10, well, a halting day. So you have to be very careful for May. Remember, this is the 3rd year for a presidential thing. It's when they do all the nasty stuff, which, because it's 2020 is far away. And as we like to say, and you're seeing it already now, Trump is going to be playing tough. No more Mr. Nice Guy. Now, what that means is going to be very interesting with Trump, but he's going to be playing very hardball. You're going to see a lot of things going on, lots of fights in Congress. You haven't seen anything yet. But the second half of the year is generally positive. So it's going to be a lot of shit going on, flying around. So Trump, we talked about, that's the big picture. U.S. markets, caution in the fall. We saw that. We are expecting a rally, and we're still expecting it in the next 3 days. So, hey, not necessarily today. We have to see where the markets close. I'll take a look. Not necessarily Monday, but the last 3 days, I think we'll see a rally. Anyway, it's a trade we'll make. We won't fight the trend, but we'll probably buy it. We may not hold it long, but we'll try it. And NASDAQ, of course, is going to be an interesting issue. That's really volatility. Gold will be at least long into January, February. Then we will actually protect because it can go down, I don't know, but it will go back up again. So again, traders, that's a very important thing. And Bitcoin has to worry about outside influences. And China's Saturn all year, and that means debt has to be watched. And they have to really put their house in order. I hope they do. It would be nice for everybody. So that's the basic astrology, and we can talk about that in some detail later. Now, markets were easy last year. They're not anymore. That's it. Forget it. We had plenty of time where they were easy for the last year or two. They're not easy now. We basically had two plays at the beginning of the year. Every time the market goes down, buy it. For the first half of the year, we were playing 3 interest rate increases, not 4. That was very profitable. And then it was clear the Fed was going to play a different game, and we had to stop saying it. We didn't say there was a need to go away in May. So what we're looking at is when the Dow is under 23,000 or the S&P under 2,500, it's a little negative, but we think it's a little bit undervalued there. The range is, we're putting up there. Those numbers are going to change on the 1st because we have to see if we get the rally we're expecting Wednesday to Friday. But the markets are going to favor traders over investors. And it's going to be range bound with an upward bias in the second half of the year, not necessarily the first. We're not going to be aggressive shorts. At this point, actually, we're looking for day trades to buy, but very carefully. If we saw what happened with oil, for example, we bought it at 46 and then came back down to 46. So if you didn't take your profits, they went away longer term. So one can be very short term, but they're not easy anymore. So that's the difference. You have to be either very, very short term or very, very long term. Midterm is going to be up and down, up and down, up and down. Chinese astrology. Well, depending on who you read, it's a really great year. It's not our view, by the way, certainly not for the Chinese. But it's a year that there'll be plenty of opportunities. So is it a great year to make money? It's a good year to make money, but not in the Chinese markets, I'm afraid. So it's the year of the Earth Pig. You got to sort the wheat from the chaff. In other words, be what you buy. Indices will do okay if they're not going anywhere, which is why people are looking at cash. If there are 2 more interest rate increases in the first half of the year, that brings up close to 3% positive, and people are going to buy bonds. They're going to put money in cash. So they're going to be raising cash levels. That may be all they'll do, but that will be competition for the stock market for a while. But you ain't seen anything yet. We're going to talk about this next year. 2020, new game in town. There's a 20-year Jupiter-Saturn cycle, the great conjunctions, new game. And if you're Chinese, we have a new 12-year cycle. So 2020 is a whole new ball game, but we've got to get there first. It's not a straight line to get there. There's a lot going to be happening, all new game, but we're not there yet. But let's say it's coming. It's not here yet. You're going to have to do some big portfolio changes for 2020. So valuations. We are cosmic value players. We like to buy when it's under. We like to sell when it's over. The only thing that's in valuation for us at the moment are tips. Did well when they were 112, 113, 114, under 110. So they're properly valued. Everything else, the bonds, certainly under 285, I don't buy it. Oil under 55, I think it's going to be a 55, 60 year. Not as high as many people in the audience thought, but I do think oil's up from here. And we were, at 46 last I looked. I'll look again. Copper under 320, a joke. Bitcoin over 2,500 is a joke. People will, we're at 39.52 at the moment. Gold under 1370 is cheap. Silver under 18 is cheap. So there's a lot of fundamental valuations, but you're not going to get there right away. You're going to have to hold a bunch of those to the second half of the year or to wait, stay in cash. Having high cash levels is certainly a smart thing. One of the things we like doing are trading hedges. Those of you who track us in the newsletter, those of you that catch some of my tweets. So we were selling oil, for example, at 73, buying copper at 295. We underwound the copper excuse me, the oil at 68. Then we resold it at 72. We unrounded at 64. So if you're that type of trader, you can play the game. And here you could be buying it in a hedged position. I wouldn't be buying it separately. Again, we recommend hedges. We were playing some 1188, 1182, 1196. Hey, they're doing very nicely, aren't they? But they were against Bitcoin shorts. They're well recommend against something. Naked is more risk than we like. And if you have these type of hedges, unwinding them periodically, you'll do well. And if not, be cautious. That's all I can say. So we like trading hedges. If you're a Wall Street subscriber, premium level, you get all this stuff. And if you like Twitter, we put some of the stuff out there as well. Getting near the end. Okay. No more fear of missing out. Hey, it's not like a few months ago, right? Who's afraid of missing out? Everyone's afraid, hey, am I going to get even again? Am I going to get back to where I was? So we do have to be protective, even though markets aren't expensive and we want to be playing the long side. We have to play the short side as well, especially in May. Will 22,549, excuse me 1 second, let me just take a look at where the market is, holding it. I think that support level will hold. Anyway, if it is, we'll be buying there and or potentially Monday or Wednesday. But these are not things we're going to hold and fight the market. Not like before when we had Trump's horoscope behind us. Now we've got to follow it. We've got to no more Mr. Guy situation. The market's going to be more volatile. It's very short term. Again, the Fed will either calm things down or not in January, but lots of issues beyond the Fed next year. Think traditional Swiss, preserve capital, hedge, protect against downside risk is going to become important. Have high cash levels. I don't think there's a reason to sell now. If you haven't done it, it's probably a little late. But when they go up again, and I think they will go up again next year, we will hedge them at appropriate times. But certainly no more fear of missing out. That's an old game. How markets have changed. So what's the bottom line? The bottom line is we will have some inflation pressures. There are geopolitical concerns. There are trade war risks, emerging market concerns, especially if the Fed is aggressive. Take and protect profits often if you're a trader. And if you're not, what you must watch for is the China. Not be aggressive there. January and May FOMC meetings, certainly May anyway. Maybe they'll lower rates in May. If they do go in January, again, the market's going down again another level. So you have to be very protective about that. They don't seem to care as much as they should. And then they say they care about it and the market goes up. But that's not a confidence-building Fed. And they've lost a lot of confidence and they've got to do something to redo it. But then again, over time, markets will do well regardless of the Fed. Okay, so that's the bottom line. So the summary is this. If you're not an active trader, you've got to protect profits. If it's fresh money you're putting in, selective stock picking will outperform index investing. Very important. We recommend raising cash levels, writing calls. Haven't done it. You may want to wait a bit. And new trades, if you can, are best done in long-short pairs, especially those of you that are more professional. Markets are no longer overvalued. They're not cheap. They could get cheaper. Yesterday, I got a text from one of our presenters, Rod Husband, who's presented Cypher at our conferences and said, who said 21,000 Dow? Who said $1,500 gold? And I couldn't remember. A couple hours later, I remember those were his trading targets. I'm not saying we'll go to 21,000. I don't think we'll break 22,000. We could, though. And 22.5 is which is we're pretty close to. We'll do a fight, but we won't fight aggressively. Market goes against us. If it goes up, we'll take some profits and trade accordingly. But a bottom, I think, could be in very well. We may have seen it, or we'll see it, or we may not. You have to. It's not clear. It's good for traders. It's not clear. There's a lot of risk. But we said that December 5th. We're saying it again here. A lot of opportunities. What we like in general, we like royalties because of cash. We like natural resources, clearly. We like some cryptos, our black coin. That's only if you lose, they're very aggressive. Healthcare, technology, privates, and some other things. So we have our newsletter for those who are interested. We have luncheons in New York for those that are professionals. And that's basically it. I think we're about ready. We think if you use astrology and technicals, you're there first. If you invest, you get a stellar performance. We have a lot of events coming. So I think we'll take our questions. So give me about 30 seconds just to look at the markets. When we were at 4,000 Bitcoin, we recommended selling it, but that's a day trade. We get out of it again. And let's see where the other things are. Okay, oil's doing well. And markets are testing the 22,800 level. So we'll probably do a little over. We'll do some buying. That up, that slide, and then we'll take some questions. Okay, we'll go. I've got a question here. Trump impeachment. First of all, let's talk about what does impeachment mean. Whether someone is challenged or not means absolutely nothing, because the fact is the House has, Trump was very, very smart to get 53 Republicans into the Senate, so they can't possibly do a real impeachment. Whether the Democrats will try to bring cause to it, I'm afraid I'm very much against that as a sensible thing, but it will roil the markets. It won't be a successful impeachment. So will it bring the market down in the first half? Maybe. Will it be successful? Absolutely not, because in the second half of the year, he wins. So it will be a rough year for him. Maybe having the impeachment could be one of the issues, but it's nothing to salivate over if you're a Democrat, and it ain't going anywhere. And I think it would be nice if what Pelosi had said, which is that they work on areas where they agree, such as lowering healthcare costs, such as doing infrastructure, which they both agree on. I'd love to see that. A divided House could work well. I think it would be wonderful for the American people if they take the areas where they agree on. When I was growing up, politics was defined as the art of compromise, and for the last 20, 25 years, it's my way or the highway. I think that's very unfortunate, and I'd like to see the compromise again. If it is, everybody wins. But clearly, the impeachment, he's going to do well in the second half. Very rough first half of the year, but that means no more Mr. Nice Guy, and there'll be a lot of actions. Basically, will value stocks do better than growth? I think they'll do better in the first half of the year. The second half of the year, probably growth will do better, except for the fact that we have the Jupiter-Neptune, and the Jupiter-Neptune is good for growth, meaning it's a mixed ball game. So I'll have to concentrate that and say, in general, value will do better in the first half of the year, but there'll be months when growth will do better. In other words, it is not an easy market. The second half of the year probably will be growth. But the first half of the year, value is a safer trade. Value will go down less. So I think most of the time it will do well, but there are times it won't be. It's just not an easy market. We're going to be very short-term focused. But if you're not an active trader, I think it's a much safer place for the first time. And then again, what are you going to do about May? They'll go down less if we're right, but they're going to go down. So if you're writing calls on them, I think you'll do better. So we have defensive things doing well now, and I think that's going to continue. It's going to be a lot of risk off. This is very interesting. The death cross issue. They sometimes hold. I believe that what we're seeing now in the last few days has been the case. I don't think it's going to stick. 22,000 now is a buy to me. It's value. But is it an aggressive buy? Can it get cheaper? Can it go to 21? Sure. Can the S&P get cheaper? Absolutely. The question is, how much cash do you have? And, the question is, how well prepared are you? I'm certainly not going to recommend going long by using margin. That would be insane. But we have high cash levels. It's an issue. I think it will send some people selling. But we'll see today. I'm not even sure today is going to end up negative. We have to see how the market is around 2 o'clock. Or when this is over, I may be very inclined to just put a little buy-in. I'll let myself get stopped out. I won't go long over the weekend because Monday's a little messy because of the shutdown. But I don't think it's the horrendous. If you had asked me this question 2 weeks ago, it was a very different answer. Now I'm sort of inclined to sort of nibble, but I'm not going to be aggressive on the long side because there's a lot of risk here. So we're going to be very short-term trades. Like, for example, if you had looked at what happened when the Fed was talking, it was so clear when the first day is down, the second day was going to be up until an hour before. There was an easy 300 points in the Dow. Then you had to get out by 1 o'clock because the market was going to do differently. So if you play those games, you don't care as much. If you don't play those games, yeah, no question about it. Is this the time to sell? I don't think so. But depends on what you own. If you're in good value stocks, I wouldn't be worried about it. So again, this is a very short-term or long-term market. I think will we be higher at the end of next year than now? Yes, I think so. So that's a question that's not asked. I do think the market will be higher. So, but is it a straight line? Absolutely not. Okay, let's see. We got more questions here. We have a raised hand. Okay, let's bring Rosario. Am I doing this right, Mike? Let's see. Oh, he's on video. Okay, so how do we get his question? If you don't have video, the raised hand doesn't work. Please write your questions. I'm sorry, I'm not as familiar. There's some more questions. Okay, we have a couple more we're trying to get in here. We'll give it a little bit of time. I wish it could have been as easy as last year. If you take a look at last year, it was so much easier. But then again, it's more fun. So traders will have fun. And if you look at the market here, I think we've close to a bottom. And if you give me a second, how low did we go? It's, 500 level. Hell, except for the NASDAQ. I don't trust the NASDAQ. I'd rather long the Dow and short NASDAQ. Hey, that's the way to play. But short term. Again, these are tricky markets. These are just going to be tricky markets with a lot of risk. Okay, I think we may have most of the questions. I'll give it another minute or two. If anybody wants to ask any more questions. It's definitely not a boring time. As the Chinese would say, we live in interesting times, and the markets are going to be very, very interesting. But if you watch your cash levels, if you're prepared for May, I wouldn't worry about it so much now. We have to see January. I do think there'll be a little up in the last 3 days. Maybe from here. Again, if you haven't done anything, I wouldn't do too much at this point. But as we get later in the year and as we get to the second half of the year, you must do something then, or there'll be another 5 or 10% potentially in the market. Well, okay, we got one more question and then we're out of here. Why don't I see it? Okay, I'm going to clear the questions and start over for a second. One moment. I'm missing someone's question. If I didn't ask you a question, we'll try one more time. Sorry. Anyway, I want to thank you all, while we're seeing if there's a last question, for attending. This will be published online in the next 2-3 days on YouTube. You can watch it. You can also rewatch last year. Oh, gold in 5 years was the last question. Higher. Sorry. Will at least be, when we get over 1,400, ask me that question. I'm not a gold bug that we're going to 2,000, that the world's going to end. I do think we'll certainly see over 1,400. Maybe you'll see as much as 1,500, and there I'd be probably selling, unless situations change. 5 years is a long time. We use a 2-year horizon. And the next 2 years, gold is definitely up. It's definitely going to be far higher in December 2020 than it is today. It's definitely going to be higher in December of 2019. Those are trades I can give you 90% certainty. 5 years, I haven't even looked. I want to own some, but I don't think that's an issue. I wouldn't put everything into gold any more than I would put anything into Bitcoin. You want to be diversified. There's a lot of issues ahead, and it's not all clear. This is not okay. But again, first half of the year makes sense. I'm being asked about 2 specific stocks. I'll take a couple. Copper Bank is a copper company, therefore, in general, we like it. It has 2 people in the management team, one of which is someone who talks about copper all over the world and therefore is a benefit, and the other is a very sharp guy who's run some copper deposits beforehand. I think it's a much better play than it was before. And at a couple of pennies, I think you could put something in. I wouldn't put all my copper money into it. I think it's, if you want to diversify, say, among 5 companies, I think you'd be all right with that. I wouldn't put it as the only one, but I do think it has some value because most copper ones did. A bigger one for us was Trilogy, which doubled last year. We think it's going to double again. We showed it off in Hong Kong, so Trilogy is a little stronger for us at that level. But I think it's going to go up. MGX is an interesting play. They're all over the place, but I like the guys. I think, again, it's a cheap stock. I'd put in a basket of 10, not in a basket of 5. You've got to play these things like that in a big basket. When you go into the micro cap and the nano cap area, no matter how good the company is, you may have to wait another 2-3 years. Some of them are going to hit, and they've got a lot of very interesting plays, very many interesting lithium plays. So it's something we sort of like, but not the most aggressive at the moment. But again, there's so many. Literally, there are about 30 companies that I'd like to buy, and we might put 20 of them together. We have to wait and see. We have some cash now. I want to see if these numbers hold. There's a 30% chance that we've seen the bottom. Markets can do whatever they want then. And if you have to be very careful for your trader in the last 2 weeks of August and the last 2 weeks of December. You sort of want to lock it out earlier, and you're much happier, I think. Well, thank you very much, everybody. I appreciate your coming. I hope you found it of value. It will be posted, and we'll send you all a copy of our current Wall Street next week. You're welcome to subscribe.